Hello and welcome to our Principles of Accounting 2 tutoring session over budgeting. Today we're going to have an introduction to budgeting that will help you prepare budgets in the rest of these chapters. So today we're going to be talking about Chapter 21. Chapter 21 starts on page 1082. So if you're not already there in your book, I'd tell you to flip there. If I was to ask you what word would pop into your mind when I said the word budget, the first thing that would pop in your mind would probably be the word plan. Okay, you're going to plan to buy something. You're going to plan how much something's going to cost. Okay, and the formal definition is just that. In this chapter, a budget is a formal written statement of management's plans for a specified future time period expressed in financial terms. Okay, so management is going to have a budget of how much they want to have in sales, then how much they have in sales, how much do they need to produce, all the way down to how much they're going to have budgeted in income. Okay, so the first chart I want you to look at is on page 1086. In preparing a budgeted income statement, which is the end idea of all of this, you'll notice that's in the green box. Okay, that's after a bunch of other stuff. So there's several different steps you have to take to get certain values that go on your budgeted income statement. And throughout this video, we'll be talking about each of these steps and how they correlate to the end product. So the very first thing you see is the sales budget. In order to see how much you're going to budget in direct materials, direct labor, all of that type of stuff, you have to know how many units you're going to sell. Okay, so if I'm going to sell 5 million copies of this book, okay, I know how much sales I'm going to have, therefore I can budget how much in labor and materials I'm going to spend. Okay, so kind of a broad example. Once you have your sales, once you know how many units you're going to sell, you need to know how many units you need to produce. So that's your production budget. So you've got sales, how much you're going to sell, production, how much you need to produce, and then right below that you'll notice you've got your direct materials budget, your direct labor budget, and your manufacturing overhead budget. So in order to produce stuff, in order to produce units, you have direct materials, you have your direct labor, and you have your manufacturing overhead. So that's where you get that. So you start with your sales, then you go from sales to how much you need to produce. From how much you produce, you make budgets on how much direct labor, direct materials, and manufacturing overhead you will incur. Okay? The next thing you have is selling and administrative expense. That's a budget also. So once you figure out how much you want to sell, then you do how much you need to produce with all of the factors that go into production. You have to figure out how much we need to allow in the budget for selling these. Okay? And you do that also. Everything starts with the sales budget. How much are we looking to sell? Okay? And then those bottom pink boxes we won't get into in this video. So just as far as we're concerned, the ending will be the budgeted income statement. Okay? So one last thing I kind of want to point out is a budget can most of the time be for 1 year, okay? But as we're looking at this, you'll see different quarters. A couple of your problems might have just 1 quarter or 2 quarters or 3 quarters. So if we took an example of jackets, okay, in the spring and summer quarters, a retailer's not going to sell that many jackets, okay? So as far as of those units, okay, and I say retailer, but we're dealing with production. So a company is not going to sell as many jackets in those quarters, unless they're in areas where they can branch out. But just in general, people in the United States aren't going to go buy a jacket in the summer, most likely, okay? So in that quarter, their sales might be kind of low. But in the winter and the fall, their sales are going to be higher, okay? So that's when you'll get into your sales budget, okay? So the first thing on page 1087 is the sales budget. So that's the very first thing, like we just talked about what you need to do. So if you'll look at illustration 21.3, that's a picture of a sales budget. And you'll have to do, if I understand correctly, each of your, like some of your homework problems, it might have the entire budget and income statement, or it might just say create a sales budget, create a production budget, or direct materials, direct labor budget, okay? So for sales budget, you need to know, one, how many expected unit sales, okay? How many units do you want to sell, okay? And then you have to know your unit selling price. How much do we get to sell these units for, okay? And in this particular example, Hayes Company, up in the paragraph above, they want to have 500 unit increase in each quarter. So that's why you have 3,000, 3,500, 4,000, 4,500, okay? Then you multiply that by the unit selling price to get your total sales for each quarter and then sum them up for the year, okay? So sales budget is where you start out and it'll have those 3 elements, okay? The next one you'll need to do is the production budget, and you'll need to note the formula at the bottom of page 1088. You'll have your budgeted sales units, okay, how many units in sales. Then you'll have your desired ending finished goods, okay. Subtract your beginning finished goods is equal to your required production, okay. So let's go ahead and look at illustration 21.5 on page 1089. So you've got your expected unit sales, and if you look back on the previous page, you've got that in units, okay? So it's still the 3,000, 3,500, 4,000, 4,500. Then you add your desired ending finished goods inventory. In some of your problems, it will just give you that, what they think it'll be. But in this particular example, it says it's 20% of the next year's quarter budget. So 20%, okay, if you look at, for A, it says A is 20% of next quarter's sales. So that's respective, okay? Then when you add those together, you get your total required units, okay? Then you subtract your beginning finished goods inventory, okay? I want you to notice that for quarter one, there's a 600, okay? But notice quarter two, that the beginning finished goods for quarter two is the same as the desired ending of quarter one. So you'll notice there's a diagonal correlation between 700, 700, 800, 800, 900, 900, okay? So just take that in consideration. That 600 is from the year before, okay? So the ending quarter of the year before, okay? So that's a production budget. So you've got your sales, then you've got your production budget, and then you're gonna do your direct materials budget, your direct labor budget, and your manufacturing overhead budget. So hopefully by now you're figuring out, how we're talking about this. So your example of the direct materials budget is on page 1091, okay? Here you've got your units to be produced, okay? Then you've got your direct materials per unit. So in this example, I believe it's 2 pounds goes into every unit. So for quarter one, you've got 3,100 units to produce that have 2 pounds of direct materials. So the total pounds needed are 62 for quarter one. Then you'd add your desired ending balance material in pounds, okay? And you'll see the little subunit A, it says 10% of next quarter's production requirements. So 10% of quarter two's total pounds is 720, and you'll see how those numbers are also diagonally correlated, okay? That gives you your total materials required, and you'll be doing this the same for each of these quarters. So we're just talking about quarter one for this example. Then you'll take out your beginning direct materials in pounds, okay? Then that gives you your direct materials purchases, how much you need to buy in order to make what you budgeted as production. And then it'll give you your cost per pound. And this will all be given to you, at least your cost per pound and things like that will be given to you in the problem. So you'll multiply that by the cost, and then you have the total cost of direct materials purchased, okay? So the first budget we did, just going back, talking to where we are now, you had sales. You found out how much you expect in sales for a year, okay? Then you did production. If we want that amount of sales, how much do we need to produce this year, okay? Now we're looking, if we want to produce that much this year, how much direct materials, and now we're about to talk about direct labor and overhead, do you have to have for that, okay? I believe the next page, it's turn 2 pages over to page 1094. At the very top, it has the direct labor budget. This is one of the easier ones. This one, you'll just have the units to be produced, the direct labor time per unit that goes into a unit. So for this one, it takes 2 hours for each unit. That gives you total required direct labor hours, and then you figure out the direct labor cost per hour and multiply that out. So to produce all of those units, it would cost $308,000. Okay? That one's pretty easy. The next one is the manufacturing overhead budget. This one it gives you your indirect materials per hour, indirect labor, utilities, and all that. If you'll remember the predetermined overhead rate, some of your problems will just say that the manufacturing overhead is 150% of direct labor, okay? So you'll have to keep that in mind. So it won't always just be like this, but you'll notice you have your variable costs, your fixed costs, and then your total manufacturing overhead as you figure that out, okay? So that's the manufacturing overhead budget. And then, like we talked about, going back again, we've got our sales budget, production, okay? Production, we've got direct materials, direct labor, manufacturing overhead. Now that we've figured out how much we've budgeted to make all these units, now we've got to figure out how much we're going to budget to sell all of these units, okay? So now we've got budgeted sales in units, variable expenses, and fixed expenses, okay? And sometimes, again, it'll be simplified a little bit more than this, and they'll just give you, I can't think of an example right off the top of my head, but they might give you a percentage of selling. It takes 30% of the unit cost to sell the unit, something like that, okay? And now we're finally at the budgeted income statement, which is the very last part. So if you look at illustration 2113 on page 1096, this is what we're talking about. So all of these numbers, you'll see sales, cost of goods sold, gross profit, selling administration, all of those things. We've just figured out all of those things, okay? So one problem that I've got just sitting here, okay? So for this one, I did the sales budget, the production, the direct materials, okay? Then the direct labor, manufacturing overhead, selling administration, okay? And then you have to do the cost of one bag, okay? Which you can look at in illustration 2112, okay? And that's on page 1096, where you figure out how much per unit goes into, how much direct materials, direct labor, manufacturing overhead goes in one unit. Then you just pull off those numbers off of all of those reports we just did into the budgeted income statement. So you just copy those numbers and you can look at that example and it's the same thing, okay? So we just talked through all of budgeting, okay? And the end product is the budgeted income statement, okay? So we've just talked through all the parts, okay? You've got sales budget, production budget, direct materials, direct labor, manufacturing overhead, selling and administration budget, and then you've come up with your budgeted income statement. So that's all I've got for this video. Hope that was helpful. All that was walking through a budget. So good luck making your budgeting income statements, and we'll see you next time.